Hi there, my name is Dennis Wiebe. I'm with Realty Executives First Choice. I wanted to go through the BRRR strategy. I felt it was important to do a video like this to be able to share a personal example of what I do with a BRRR strategy. I have a live example where I've actually got a property under contract, and I'm going to be walking through this through several videos of how I approach a BRRR strategy. So for all my newer clients or people who are potentially interested in getting into real estate investing, it is basically my preferred strategy for real estate investing. So first off, what is BRRR? So the acronym is there. It's buy, renovate, refinance, and rent. These can be alternated. In my case, I'm actually going to be continuing to rent and then refinancing once all the renovations are done. This is a common strategy to be able to buy a property that needs a little bit of help, do the work to it, and then reset the rents so that they're at a fair market level. Hopefully you've done all the right renovations and an appraisal will drive the price up, and you can refinance and get a larger first mortgage and get your money back out. So I'm going to run through the example of my situation. I have currently a fourplex under contract, and it's one that I feel that I'm buying at a good price, and I can renovate it, reset rents, and drive the price up to be able to refinance it and capture not only my renovation money, but probably a big chunk of my down payment back into my pocket, and then just let the property run. I now have that ability to take that money and move on to the next property. So that really is, in a nutshell, the BRRR strategy. So I'm going to walk you through the property that I've got and just kind of run through the numbers so that you understand how and why I decided to actually purchase this particular property. So my property it's actually a fourplex. And the revenue stream has to be reasonable. So in this case, it's got 3 suites that the current rents are $900 on the main floor, $1,000 on the second floor. The top floor is at $725, and the basement unit is at $680. So in this case, it's a large 2.5-story building, and it's got 4 suites, 1 per level, 1 in the basement, 1 on main floor, 1 on second floor, and 1 on the third floor. So my total rents are actually quite nice. It's actually, I believe, I'll just do quick, I believe it was $32.05 per month. So a really good revenue stream. My purchase price that I currently have this locked in at is $265,000. So if I break that down, because one of the common things that we look at is what is the price per door that we are purchasing, because it does vary dramatically by the neighborhood. So I'm at, let me see here, $66,250 per door. And I own another property in a similar neighborhood, just a little bit further north, not quite as good a neighborhood. And I have that building just recently appraised at $92,000 per door. So then I started to look at this and I said, okay, if I can get it at $265, that's $66,250 a door, and I know that I can get at least $92,000 a door. I estimate I should be able to refinance it at probably around $95,000 to $100,000 per door, which is a really nice variance off of the $265. If I could get, refinance it for $380, something like that. After I did an initial walkthrough of the building, I determined that I need to do a little bit of renovation because that is really the point of this, that I will be doing some renovation. And it's going to be requiring somewhere between 10 and 15K per unit, okay? Plus I've got some common area that I'm also going to need to renovate, which is probably going to be another 15,000. So if I take it at this high level, the 15,000 times 4 units plus the common, so I'm going to multiply it by 5, so that puts me at 75,000 in renovations. So now if I can take that and apply that, because I needed to buy this at, I bought it at 265. Now I'm going to do the mortgage. The mortgage equates to, quick math, 65,000, and I financed it at 80% of loan to value, which equates, my down payment is actually 52,000, which means that my mortgage is going to sit at 213. Plus I'm going to bring the 75,000 into it. And my total cash investment, once I'm completed this, is actually going to be 127. My goal is, I'm just going to use round numbers. I want to hit 400,000 in the future purchase. So 400,000 at 80%, the bank is going to give me a mortgage for 320,000. So how much of my money am I going to get back? So I have my, a little too much on the board here. If I have my mortgage at 320 in the future, and my current mortgage was 213, the variance between those is actually 107,000, which means I'm going to get all of my money back because I'm looking at the total cash investment, and after I refinance it, the bank is going to give me back 107,000. So I will only be left with $20,000 left in the property. So once I've got that situation, I look at this and go, wow, this is actually going to be a really good longer term cash investment, because my return on investment on that 20,000 is going to be quite large. So let's just take a quick look at what my future investment is going to look like in this one, so that I can determine long haul, is this going to generate a reasonable amount of money for me, or am I going to be struggling to cash flow on an ongoing basis?